You wake up at 4:30 a.m. Your phone is buzzing. 17 missed calls from the Federal Reserve. 32 messages from heads of state. Your inbox is flooded with red alerts from Aladdin, your risk management system that tracks $21 trillion across global markets. You are the CEO of BlackRock, the largest asset manager on Earth. You control more money than the GDP of every country except the United States and China. And right now, at this exact moment, a cascade is starting. Market makers are pulling liquidity from your ETFs. Redemption requests are piling up, billions per hour. Your algorithms are screaming warnings about systemic contagion. One wrong move and you don't just lose money. You trigger a financial meltdown that makes 2008 look like a practice run. The president is calling. The Fed chair is demanding answers. Your board is panicking, and you have less than 6 hours to decide. Do you freeze redemptions and risk destroying trust in the financial system? Do you liquidate positions and crash global markets? Or do you find a third way that nobody has ever thought of before? The clock is ticking, and billions of people are counting on you, whether they know it or not. Before we dive into this nightmare scenario, hit that subscribe button right now, because this channel is the only place where you live through impossible decisions that shape the world. And drop a comment telling me which city you're watching from, because in a few minutes, I'm going to need your decision. Here's what you need to understand about BlackRock. It's not just another investment firm. With $12.5 trillion under management, BlackRock is the invisible hand behind nearly every major company you know. Apple, Microsoft, Amazon, Tesla. BlackRock owns massive stakes in all of them. Its Aladdin software processes risk analysis for 30,000 investment portfolios worldwide. That's 7% of the world's financial assets. Running through one system, one company, one decision-making process. When BlackRock sneezes, markets catch pneumonia. When BlackRock panics, economies collapse. And today, you're sitting in that chair. You're making decisions that will echo through history. Decisions that will determine whether millions keep their jobs. Whether retirement funds survive. Whether the global economy holds together or splinters into chaos. So pay attention, because what happens next will change everything. It's Monday morning, March 17th, 2025. You're in BlackRock's Manhattan headquarters, a 50-story tower overlooking Central Park. The view is spectacular, but you're not looking at the view. You're staring at screens showing red numbers cascading like a waterfall. Your chief risk officer bursts into your office. We have a situation. That's the understatement of the century. Here's what happened overnight while you were sleeping. A major European bank, one of the 30 largest in the world, just announced massive losses from exposure to commercial real estate. $12 billion. Gone. But it's not just one bank. 3 others are rumored to have similar exposure, and the market is panicking. Investors are pulling money out of everything that looks even slightly risky. Bond ETFs, real estate investment trusts, high-yield corporate debt, and they're all rushing into what they think is safe, government bonds and cash. But here's the problem. BlackRock manages the largest ETF platform in the world through iShares. You have exposure to everything. Your bond ETFs hold $300 billion in corporate debt. Your real estate funds manage another $200 billion. And right now, redemption requests are flooding in. Pension funds want their money back. Insurance companies are panicking. Sovereign wealth funds are pulling out. Everyone wants cash. Now, in the first hour of trading, you've received redemption requests totaling $47 billion. That's not unusual during a crisis, but it's accelerating. By hour 2, it's $63 billion. By hour 3, it's $89 billion. Your head of ETF operations explains the mechanics. When investors redeem ETF shares, we have to give them either cash or a basket of the underlying securities. If we give them cash, we have to sell the bonds and stocks in the fund. But if we sell into a panicking market, we crash prices even further, which triggers more redemptions, which forces more selling. It's a death spiral. You've seen this before. March 2020, during the COVID crash, your bond ETFs traded at massive discounts to their underlying assets because nobody wanted to buy bonds. The Federal Reserve had to step in and backstop the entire corporate bond market. It worked. Then. But this time feels different. The Fed is already fighting inflation. Interest rates are at 5.25%. The central bank doesn't have the same room to maneuver. And there's another problem. Your Aladdin system, the software that manages risk for thousands of institutional clients worldwide, is showing correlations that shouldn't exist. Normally, when stocks fall, bonds rise, it's basic portfolio theory. But right now, everything is falling together. Stocks, bonds, real estate, commodities. It's the nightmare scenario that risk managers pray they never see, because it means there's nowhere to hide. Your chief technology officer brings more bad news. Aladdin is processing 2 million risk calculations per second right now. We're stress testing every portfolio against historical scenarios. 2008, the long-term capital management crisis, the Asian financial crisis. And every simulation is showing the same thing. If redemptions continue at this pace, we'll have to sell $300 billion of assets over the next 48 hours. You feel your stomach drop. $300 billion. That's more than the entire GDP of Finland, dumped into panicking markets in 2 days. What happens if we do that? You ask? Your risk officer doesn't hesitate. Market collapse, complete liquidity freeze, credit spreads blow out, borrowing costs explode. Companies can't refinance debt. Defaults cascade. Banks get hit with losses. We're talking about a systemic event. But there's more. Your general counsel walks in with another bombshell. Senator Warren's office just called. She's demanding we testify before Congress about systemic risk. The Financial Stability Oversight Council is holding an emergency meeting. They're discussing whether to designate BlackRock as too big to fail. You know what that means. If you're designated as systemically important, you fall under Federal Reserve supervision. Stricter capital requirements, stress tests, government oversight of every major decision. It's what happened to the big banks after 2008. But here's the cruel irony. You're not a bank. You don't take deposits. You don't make loans. You just manage other people's money. If your clients want their money back, you have to give it to them. That's the deal. That's how asset management works. Except when it doesn't. Except when giving everyone their money back at the same time destroys the entire system. Your phone rings. It's the Treasury Secretary. We need to talk, she says. Now. You take the call on speaker. The president is watching this situation very closely, she begins. We cannot have a repeat of 2008. We need to know, what are you planning to do? You look at the faces around your conference table, your executive team, your board members on video conference, some of the smartest financial minds in the world. And nobody has a good answer, because every option is terrible. Option 1, continue processing redemptions normally. Give clients their money. Sell assets into falling markets. Watch prices collapse further. Trigger more panic. Risk a systemic meltdown. Option 2, temporarily halt redemptions. Give markets time to stabilize, but destroy confidence in the ETF structure. Make investors think their money isn't actually liquid. Cause a run on every other asset manager. Option 3, find emergency buyers. Call in favors from sovereign wealth funds. Get the Federal Reserve to provide a backstop. Coordinate with other major asset managers. Try to stabilize markets together. But that takes time you don't have. The Treasury Secretary is still on the line. We need your answer, she says, because if BlackRock goes down, it takes everyone with it. You think about the numbers. $21 trillion managed by Aladdin, $12.5 trillion directly under BlackRock management, positions in every major company, exposure to every major market, connections to every major financial institution. You're not too big to fail. You're too interconnected to fail. The Treasury Secretary ends the call. You have 3 hours until markets close in New York, 6 hours until Asian markets open, and you need to make a decision, now. Your chief operating officer lays out the immediate options. We can handle this one of 2 ways, he says. Option A, we process all redemptions as requested. We sell assets at market prices. We give clients their cash. It's clean. It's transparent. It's what we're supposed to do. Option B, we invoke the emergency suspension clause. ETF rules allow us to temporarily halt redemptions during extraordinary market conditions. We freeze everything for 72 hours, give markets time to calm down. You know, both options lead to disaster in different ways. Option A means you're selling into a falling market. You'll have to dump corporate bonds when nobody wants them, sell stocks when everyone's panicking, liquidate real estate positions at fire sale prices. Your head of trading runs the numbers. If we sell $300 billion in assets over 2 days, here's what happens. Corporate bond yields jump by 1.5% minimum. That translates to roughly 15% price declines, which means the bonds in our funds lose about $45 billion in value. But wait, that triggers more redemptions because our fund values drop. So we have to sell even more to meet new redemption requests. It's a negative feedback loop. Your chief economist adds context. When corporate borrowing costs spike like that, companies can't refinance. We're looking at potential defaults across the high-yield sector. Commercial real estate is already stressed. This could push it over the edge. We'd be creating the crisis we're trying to avoid. But option B might be worse. Your general counsel explains the legal implications. If we halt redemptions, we're breaking the fundamental promise of ETFs. These are supposed to be liquid. Trade like stocks. Instant access to your money. The moment we say, sorry, you can't have your money back, trust evaporates. Every investor in every ETF will start questioning whether their shares are actually liquid. We could trigger a run on the entire ETF industry. That's $18 trillion globally. Your head of client relations has been fielding calls all morning. I've talked to 12 of our largest institutional clients in the last hour. Pension funds, insurance companies, sovereign wealth funds. They're all saying the same thing. If we freeze redemptions, they'll never invest with us again. They'll pull everything the moment we unfreeze. We'd lose half our assets under management within a year. You look at the Bloomberg terminal. Markets are now down 4%. Gold is spiking. The VIX, the fear index, just hit 42. That's higher than anything since COVID. Your phone buzzes. It's Larry Fink, your predecessor and still chairman of BlackRock, the man who built this empire from nothing. I'm watching, he says. This is your call now, but remember something. In 2008, we saved the system by being transparent. The government came to us because they trusted our numbers. Don't break that trust. Whatever you do, don't break that trust. He hangs up. You think about what he meant. BlackRock's power doesn't come from size alone. It comes from trust. When the Federal Reserve needed help valuing toxic assets in 2008, they called BlackRock. When European central banks needed risk analysis during the sovereign debt crisis, they called BlackRock. When pension funds need to understand their exposures, they use Aladdin. Trust is your currency, but trust requires action. Your head of global markets brings new information. The European Central Bank just announced emergency liquidity facilities for banks. The Bank of Japan is intervening in currency markets. The Fed is having an unscheduled conference call in 90 minutes. Other central banks are coordinating. Maybe there's a third way. Maybe you don't have to choose between selling everything and freezing everything. Your chief strategy officer suggests a hybrid approach. What if we process redemptions but do it strategically? Use creation and redemption in kind instead of cash. Give institutions baskets of securities rather than selling for cash. Let them deal with liquidating at their own pace. It's technically possible. ETFs can deliver securities directly instead of cash. It avoids the forced selling, but it has problems. Most institutions don't want a basket of 200 different bonds, your COO says. They want cash. That's why they're redeeming. If we give them securities, they'll just sell them immediately anyway. We're not solving the problem, we're just delaying it. Another idea emerges. What about selective redemptions? Someone suggests. Process redemptions for liquid strategies, large cap stocks, treasuries. Suspend redemptions temporarily for illiquid strategies, high yield, real estate. It's a middle ground. Your lawyers immediately object. That's discrimination. You can't treat different investors differently. Plus, it tells the market exactly where your problems are. It would cause a panic in those specific sectors. The Treasury Secretary calls back. The Fed is prepared to open a special facility for asset managers, she says. Similar to what we did in 2008 for banks. You can borrow against your bond holdings at reasonable rates. Use that cash to meet redemptions without selling. But there's a condition. You wait. You have to accept federal oversight, temporary designation as a SIFI. And you have to coordinate with Vanguard and State Street. The big three move together or this doesn't work. There it is, the government bailout option. It would work. Probably. But it comes with strings. Strings that change BlackRock forever. Your chief financial officer runs the calculation. If we borrow from the Fed, we can meet redemptions without forced selling. But we're paying interest on that facility. And we're under government supervision. Plus, the optics are terrible. BlackRock taking a bailout? We'd never live it down. You look at your executive team. Opinions, you say. Your COO speaks first. Process the redemptions. Take the pain. We're fiduciaries. Your general counsel disagrees. Suspend temporarily. Save the system. Live to fight another day. Your chief strategy officer offers a third view. Take the Fed facility. It's what it's there for. Don't let pride destroy the company. 3 options. All terrible. All defensible. All potentially catastrophic. What do you do? Comment below. A, B, or C. Would you sell everything and risk a market crash? Would you freeze redemptions and break trust? Or would you take government money and accept the consequences? Choose now. Because in the real world, you'd have 60 seconds to decide. You make the call. Option A. Process the redemptions. You're going to sell. We're asset managers, not banks, you tell your team. Our job is to return money when clients ask for it. We sell at market prices, whatever they are. That's the deal we made. We honor it. Your trading desk springs into action. They start executing sell orders across every asset class: corporate bonds, real estate securities, mortgage-backed securities. The first $1 billion in sales goes smoothly. Market makers absorb the flow. Prices drop slightly, but nothing catastrophic. Then you hit the second $1 billion. Now liquidity starts drying up. Bond dealers widen their spreads. What used to cost you 0.1% to trade now costs 0.5%. You're losing money on every transaction just from the bid-ask spread. By the third $1 billion, whispers start circulating. BlackRock is selling. They're dumping bonds. Something's wrong. Other investors see you're selling and start front-running you. They sell before you can, trying to get out at better prices. This pushes prices down further, which means you have to sell even more to raise the same amount of cash. Your head of trading looks sick. We're in a doom loop, she says. Every sale triggers more selling by others. Prices are dropping faster than we can adjust. We're creating the crash we feared. By lunchtime on Monday, corporate bond yields have spiked 1.2%. That's moved more in 6 hours than they typically move in 3 months. High-yield spreads, the extra interest risky companies pay, blow out to 700 basis points. That's crisis levels. Companies that were planning to refinance debt can't. CFOs are panicking. Earnings calls are being canceled. Capital spending plans are frozen. Your phone doesn't stop ringing. First call, CEO of a major telecommunications company. Your fund just sold $30 million of our bonds, he says. Our borrowing costs just jumped. We're going to have to cut our dividend. Do you understand what that does to our stock price? Second call, governor of a state pension fund. My board is demanding answers. Why is our BlackRock fund down 8% today? I have teachers asking if their retirements are safe. Third call, chairman of a major insurance company. We mark our bond portfolios to market. Your selling is crushing our balance sheet. My regulators are asking if we're adequately capitalized. This could force us to raise new capital at terrible prices. Each call is worse than the last. You're not just managing your own crisis. You're creating crises for everyone else. Then the real bombshell drops. Your risk officer bursts in. We have a contagion event developing. Remember that European bank that started this? It just announced it's suspending dividend payments. Its stock is down 38%. But here's the problem. Vanguard and State Street are selling too. The big three are all dumping bonds simultaneously. We're overwhelming the market's capacity to absorb sales. You pull up the data. BlackRock selling $90 billion over 2 days. Vanguard selling $60 billion. State Street selling $40 billion. Total, $190 billion hitting bond markets. There isn't enough buying power to absorb that. Your chief economist delivers the macro picture. Corporate credit markets are freezing. Companies can't issue new bonds. Commercial real estate is next. Property values are getting repriced downward. Regional banks hold a lot of that debt. They're going to take massive losses. We're 3 days away from bank failures. Tuesday morning brings worse news. 2 regional banks announced they're seeking buyers. Their commercial real estate loan books are underwater. The FDIC is preparing emergency takeover plans. Stock markets are now down 9% from their highs. The Dow has dropped 3,000 points in 36 hours. Retirement accounts have lost $1.2 trillion in value. Margin calls are cascading through the system. Hedge funds that borrowed to invest are being forced to liquidate. Private equity firms can't exit investments because IPO markets are closed. The contagion is spreading exactly as predicted. Your general counsel brings legal news. We're facing 3 class action lawsuits already. Investors claiming we mismanaged funds. Plus, the SEC is opening an investigation into whether our selling was orderly. And Congress has scheduled emergency hearings. Senator Warren appears on CNBC. BlackRock's actions prove these asset managers are too big and too dangerous, she says. They can crash markets with a few mouse clicks. We need to break them up, now. The political firestorm is just beginning. But the economic damage is already done. By Wednesday morning, the corporate bond market has lost $800 billion in value. That's wealth that simply vanished. Pension funds are getting crushed. Insurance companies are facing rating downgrades. Endowments are cutting spending. Universities are freezing hiring. The real economy is starting to feel the pain. Companies announce layoffs to preserve cash. Capital spending projects get canceled. Hiring freezes spread. Consumer confidence plummets as people watch their 401k statements. Spending slows. The recession that was a possibility on Monday is now a certainty by Wednesday. Your chief economist estimates the damage. GDP growth next quarter, -3%. Unemployment will rise from 4% to 7% within 6 months. That's 4 million people losing jobs. All because we had to meet redemption requests. The Treasury Secretary calls. She's furious. You just crashed the market because you wouldn't take our help. The Fed facility was right there. You could have borrowed instead of selling. But you chose pride over stability. Now, the president is dealing with an economic crisis that didn't need to happen. You try to explain. We did what asset managers are supposed to do. We returned client money. She cuts you off. You're not just an asset manager anymore. Don't you understand that? When you're managing $12 trillion, you're part of the financial infrastructure. You can't just act like a normal company. You have responsibilities. She hangs up. You sit in your office as the sun sets over Manhattan. The skyline looks the same, but the world has changed. Markets are broken. Trust is shattered. The economy is sliding into recession. And it happened because you followed the rules, because you did what you were supposed to do, because you processed redemptions like a fiduciary should. But maybe that's the problem. Maybe the rules don't work anymore when institutions get this big. Maybe there are no good choices when you're managing money that represents 7% of global financial assets. Maybe being right and doing right aren't the same thing at this scale. Your phone buzzes. Emergency board meeting in 30 minutes. They want to discuss your future as CEO. The board meeting starts. 9 faces on video conference. Former central bankers, former treasury secretaries, former CEOs, the most powerful people in global finance. And they're deciding your fate. The lead independent director speaks first. We need to discuss whether you're still the right person to lead BlackRock through this crisis. The firm has lost 7% of assets under management in 3 days. That's $875 billion. Our stock is down 22%. We've wiped out $35 billion in market value. You start to respond, but he raises his hand. I'm not done. 3 lawsuits, an SEC investigation, congressional hearings. The president's economic advisor called me personally to express concerns. The question is whether we need new leadership to navigate what comes next. You look at their faces, some sympathetic, some angry, some calculating. This is corporate politics at the highest level, your fate hanging by a thread. Larry Fink speaks up. I built this company over 37 years, he says. I hired everyone in this room. I chose this CEO. And I'm telling you, firing the CEO in the middle of a crisis is the worst possible move. It signals panic. It tells the market we don't know what we're doing. We hold steady. The former Treasury Secretary disagrees. Larry, your loyalty is admirable, but the market needs a reset. A new CEO could say previous management made mistakes and draw a line. Fresh start, new approach, different strategy. It might stabilize the situation. The debate goes back and forth. But then something unexpected happens. Your chief technology officer requests to join the meeting. I have information the board needs to hear immediately, he says. Permission granted. He appears on screen, looking shaken. Aladdin just flagged something catastrophic. Remember how I said we were processing 2 million risk calculations per second? Well, the system just detected a correlation pattern that shouldn't exist. Everyone leans forward. What kind of pattern? The board chair asks. A hidden concentration risk across the entire financial system. He pulls up a presentation. Here's what we found. All the major asset managers, BlackRock, Vanguard, State Street, we all own the same stocks. That's not news. We're all passive index investors. But Aladdin just mapped the entire chain of ownership. And it found something terrifying. He shows a network diagram, lines connecting companies, clusters of ownership, concentration points. The big 3 collectively own major stakes in all the largest companies. We're talking 20% ownership or more in hundreds of corporations. And those corporations own each other, cross-shareholdings, interlocking boards. The system has become one giant network of mutual dependency. When one part moves, everything moves together. You see where this is going. That's why everything crashed together, you say. Stocks and bonds both falling. Exactly, he confirms. There's no diversification anymore. When the big 3 have to sell, we sell everything. And because we own pieces of everything, everything falls. The financial system has become one massive correlated bet. The board members look stunned. One asks the obvious question. If this is true, what happens next time there's a crisis? Your CTO doesn't hesitate. Catastrophic failure, system-wide collapse. Because there's no shock absorber anymore, no independent actors. We all move together, fall together, fail together. The room goes silent. This is bigger than redemptions, bigger than one crisis. This is a fundamental flaw in how modern finance works. Your chief strategist speaks up. This gives us an opportunity, she says. We can lead the solution, not just react to the crisis. We propose a fundamental restructuring of how asset management works. She outlines a radical plan. First, we work with regulators to create circuit breakers for asset managers. Like the stock market has, trading halts when volatility spikes. Temporary redemption delays that don't destroy trust because they're built into the system. Second, we reduce concentration, actively diversify ownership patterns. Maybe that means BlackRock splits into separate entities. Maybe it means divesting certain funds. Maybe it means new rules about maximum ownership stakes. Third, we make Aladdin's risk data public. Right now, we're the only ones who can see the full picture. That information asymmetry is dangerous. If regulators and other institutions could see what we see, they could act preventively. The former central banker on the board interrupts. You're talking about voluntarily breaking up BlackRock, reducing our competitive advantage, giving away our proprietary technology. Why would shareholders support that? Your CFO has the answer. Because the alternative is government-mandated breakup. Elizabeth Warren and her allies are drafting legislation right now. They're going to force this anyway. At least if we propose it ourselves, we control how it happens. The board chair looks at you. This is your call. You're still CEO for now. Do we fight this, or do we lead the change? You think about everything that's happened. The redemption crisis, the market crash, the contagion. It all stems from the same problem. The financial system has evolved beyond the rules designed to govern it. Asset managers aren't banks, but they're systemically important. ETFs aren't money market funds, but they run risks. Index investing isn't active management, but it creates concentration. The old categories don't fit anymore, and pretending they do just makes the next crisis worse. You make your decision. We lead the change, you say. I'll personally testify before Congress next week. I'll propose a new regulatory framework for asset managers, including circuit breakers, concentration limits, transparency requirements. And I'll recommend BlackRock be designated as a SIFI. Yes, that means more regulation, more oversight, higher costs. But it also means we survive, and so does the system. The board members react. Some nod, some look skeptical, some look relieved. Larry Fink speaks. That's going to be unpopular with a lot of people in this industry. Other asset managers will hate you. They'll say you're inviting regulation that hurts everyone. Are you prepared for that? You don't hesitate. I'm prepared to do what's necessary to prevent the next crisis. Because if we don't fix this now, the next crash won't be measured in trillions. It'll be measured in the complete loss of trust in financial markets. And once that's gone, you can't get it back. The vote is called 7-2. The board supports your plan. You're staying as CEO. But now comes the hard part, actually implementing this transformation. While markets are still panicking, while clients are still fleeing, while politicians are still calling for your head, you have one shot to get this right, one chance to turn a crisis into a solution, one opportunity to reshape global finance. No pressure. Thursday morning, you're sitting in a Senate hearing room. Cameras everywhere. Senators on the dais looking down at you. Behind you, rows of activists holding signs. Break up BlackRock. Too big to exist. Financial dictatorship. Senator Warren gavels the hearing to order. Mr. CEO, you've come here to propose solutions, she begins. But first, I want answers. Did BlackRock's actions this week cause the market crash? Yes or no? You lean into the microphone. Senator, BlackRock processed redemption requests from our clients. That's our legal obligation as a fiduciary. But you're correct that our actions contributed to market volatility, which is precisely why I'm here to propose we need new rules. She looks surprised. That wasn't the defensive answer she expected. Go on, she says. You pull out your proposal. I'm recommending Congress establish a new regulatory framework specifically for large asset managers. 3 core components. First, redemption circuit breakers. When markets experience severe stress and redemptions exceed certain thresholds, asset managers can implement temporary delays. Not freezing forever, just enough time for markets to stabilize. These would be automatic, rule-based. No discretion that could be abused. Second, concentration limits. No asset manager should control more than a certain percentage of any company. Maybe it's 15%, maybe it's 10%. But there needs to be a limit to prevent the correlation problem we discovered. Third, transparency requirements. BlackRock's Aladdin system sees risks that regulators don't. We should be required to share that data with the Financial Stability Oversight Council in real time, so they can act preventively. The hearing room erupts, journalists typing frantically, analysts updating their models, activists confused about whether to cheer or boo. Senator Warren looks at her colleagues. This is unprecedented, she says. A CEO of a major financial institution actually asking for more regulation. Mr. CEO, why should we trust this isn't just public relations? You're ready for this question. Senator, you don't have to trust me. Make it mandatory for everyone. Write it into law. Apply it to all asset managers above a certain size. BlackRock, Vanguard, State Street, all of us. Because if only BlackRock does this voluntarily, we just lose market share to competitors. But if it's the law, then everyone plays by the same rules. A Republican senator jumps in. Mr. CEO, what you're describing sounds like government control of private enterprise. How is this different from socialism? You anticipated this too. Senator, we're not talking about government controlling investment decisions. We're talking about government setting rules for market stability. Just like we have circuit breakers for stock trading. Just like we have capital requirements for banks. Just like we have margin requirements for brokers. Nobody calls those socialism. They're sensible risk management for systemic institutions. The debate continues for 3 hours. Questions about implementation. Concerns about unintended consequences. Worries about competitive impacts. But something remarkable happens. Bipartisan support starts emerging. Progressive senators like what they're hearing about concentration limits. Moderate senators appreciate the transparency proposal. Even some Republicans agree that systemic risk needs management. By the end of the hearing, Senator Warren makes an announcement. We're going to draft legislation based on this proposal. The Asset Manager Reform Act. It'll take time to get the details right. But this hearing has convinced me we need to act. You walk out of the Capitol building. Your general counsel meets you on the steps. That went better than expected, she says. But we have another problem, the market. You check your phone. Markets opened higher on news of your testimony. Investors like regulatory clarity. But then reality set in. The economic damage from earlier in the week is still unfolding. Companies are still announcing layoffs. Banks are still reporting losses. The recession is still coming. Your stock is up 5% on the day, but still down 18% from the start of the week. You head back to the office. Emergency management meeting. We need to address client flight, your chief client officer says. We've lost $875 billion in AUM this week. If redemptions continue at this pace, we'll lose $2 trillion by year end. That's 20% of our business. Your chief marketing officer has a plan. We need a trust restoration campaign. Open letter to clients explaining our actions. Transparency about holdings and risks. Commitment to new standards before they're even law. Show leadership, not just compliance. You approve it, but you know it's not enough. Your chief strategy officer presents the long-term transformation plan. Here's what BlackRock looks like in 3 years if we execute this right. She shows a restructuring proposal. We split into 3 entities. BlackRock Index, passive funds following market indices. BlackRock Active, actively managed strategies. BlackRock Technology, Aladdin platform as a standalone company. Each entity smaller, each entity less concentrated. Together, they're still powerful. But separately, they're not systemically dangerous. The plan is bold, maybe too bold. Your CFO runs the numbers. This will cost us short-term, reorganization expenses, lost synergies. But long-term, it could work, especially if regulation is coming anyway. Better to control the breakup than have it forced on us. Then your CTO drops a bombshell. I found something else in the Aladdin data. Everyone turns. Remember the correlation problem I showed the board? I kept digging, and I found the solution. He pulls up a new analysis. If we change how index funds weight their holdings, away from market cap weighting toward equal weighting or GDP weighting, we break the concentration. Companies would still be owned by multiple funds, but not in the same concentrated way. It reduces systemic correlation by 43%. And it doesn't require breaking up companies, just changing how we calculate index weights. Your chief investment officer considers this. That's revolutionary. Index funds have used market cap weighting for 50 years. But mathematically, this could work. And it might actually produce better returns for investors. Because you're not overweighting overvalued companies just because they're big. You see the pieces coming together. Regulatory framework from Congress, structural reorganization of BlackRock, fundamental change to index methodology. Together, they address the systemic risk problem. Not perfectly. Nothing's perfect, but better than the status quo, better than waiting for the next crisis. Your phone rings. It's the Treasury Secretary. "I watched your testimony," she says. "The president wants to meet with you. Tomorrow. Oval Office." You agree. Friday morning, you're sitting across from the president. He's direct. You crashed the market Monday. You proposed fixing the system Thursday. Which one is the real you? You don't flinch. "Both, Mr. President. I followed the rules and the rules failed. So I'm proposing new rules. Because the alternative is worse." He studies you. "You know you're going to lose money on this deal. Competitors who don't restructure will eat your lunch. Why do it?" You think about the answer. About the teachers and firefighters whose pensions BlackRock manages. About the retirees depending on steady returns. About the stability of the global financial system. About your legacy. Because $12 trillion isn't just money, you say. It's responsibility. And I'd rather be remembered for fixing the system than breaking it. The president nods. "Okay, you have my support. But if this doesn't work, you're done." "Understood. Understood." You walk out of the West Wing. The cameras are waiting. You give a brief statement. BlackRock is committed to leading financial system reform. We're implementing new standards. We're restructuring our business. We're working with regulators to prevent future crises. This isn't about BlackRock. It's about building a more resilient financial system. One that serves everyone, not just in good times, but especially in bad times. Markets closed that Friday up 2%, still down 6% for the week, but the bleeding has stopped. The narrative is shifting. From BlackRock crashed markets to BlackRock is fixing markets. It's not victory, but it's survival. And in a crisis, survival is victory. And that's how a single week can change everything. You started Monday as the CEO of the most powerful financial institution on Earth. You ended Friday as the person who admitted the system is broken and proposed fixing it. The easy path would have been denial. Blame the European bank. Blame market conditions. Blame anyone but yourself. But the hard truth is this. When you control $12 trillion, you're not just playing the game. You are the game. And if the game is broken, you have a responsibility to fix it. Not because it's profitable, not because it's popular, but because millions of people are depending on you, whether they know it or not. So what would you have done? Would you have sold everything and watched markets crash? Would you have frozen redemptions and broken trust? Would you have taken government money and accepted oversight? Or would you have proposed restructuring the entire financial system? Drop your answer in the comments. Hit that like button if this made you think. Subscribe because next week we're doing another impossible decision. And share this with someone who thinks they could run BlackRock better than the real CEO. Let's see if they survive the first crisis.